There is something quietly unusual happening in global finance right now, and the strangest part is how little attention it's getting. The people who manage the world's money, the institutions that set interest rates, print currency, and maintain what we call the financial system, are doing something that doesn't quite fit the story they've been telling in public. They are buying gold. Not occasionally, not in small amounts, not as a hedge on the margins. They're buying gold at a rate not seen in over 50 years. And they are doing it right now, even as gold has surpassed $5,000 an ounce, a price that would have seemed like science fiction just 2 years ago. Welcome to Chart Chamber. Today, we're going to walk through exactly what's happening in the gold market, why it's happening, and what the behavior of the world's most powerful financial institutions might be telling us about the broader monetary system we all live inside. This isn't going to be a pitch for gold or a warning about collapse. It's going to be a calm, honest look at the data. And the data, once you see all of it laid out, raises some genuinely interesting questions. Let's start with the numbers, because the numbers are remarkable. At the start of 2023, gold was trading at just under $2,000 per ounce. By late 2025, it had surpassed $4,000. And as of early 2026, it has crossed the $5,000 threshold, a move of roughly 150% in roughly 2 years. To put that in perspective, that's one of the most sustained and dramatic price surges in modern gold market history. It exceeded even the notoriously explosive run of 1979, which had been driven by double-digit inflation, oil shocks, and deep political instability. The 2025 jump, at around 65% for the year alone, was the single largest annual gain for gold in modern records. Wall Street's biggest institutions have been forced to revise their price targets upward repeatedly. JPMorgan's research division now projects gold averaging near $5,050 per ounce by the fourth quarter of 2026, with $6,000 a realistic longer-term possibility. Goldman Sachs has raised its year-end 2026 target to approximately $4,900. Bank of America sees upside toward $5,000. UBS sits at $5,400. Deutsche Bank, historically more cautious, has raised its 2026 average forecast to $4,450. The breadth of bullish institutional conviction here is not typical. When banks like these converge, it's worth paying close attention to the reasoning behind it, not just the numbers. And the reasoning brings us to something that most financial commentary tends to gloss over quickly. What is actually driving this? It's tempting to explain gold's move purely through the lens of standard macro factors: inflation fears, falling interest rates, a weakening dollar, geopolitical tension. And yes, all of those things played a role. But if you look carefully at the data, there's a force underneath all of those surface-level narratives that deserves far more scrutiny. That force is central bank demand. Between 2022 and 2024, the world's central banks collectively purchased more than 3,200 tons of gold. In 2022 alone, they bought 1,082 tons, the highest annual total ever recorded for central bank gold purchases in modern history. In 2023, they bought 1,037 tons, the second highest on record. In 2024, they exceeded 1,000 tons again. And in 2025, the World Gold Council estimates that central banks purchased approximately 863 tons, a slight moderation from the peak years, but still roughly double what the historical pre-2022 average had been. For context, the average annual central bank gold purchase in the decade from 2010 to 2021 was around 400 to 500 tons per year. What we have witnessed since 2022 is, by any historical measure, an extraordinary and sustained institutional pivot. To understand why that matters so deeply, you have to understand what central banks are actually doing when they hold gold, and why they spent several decades doing very little of it. Go back to 1944. The Second World War is winding down, and 44 nations gather in a small resort town in New Hampshire called Bretton Woods to design a new global monetary order from scratch. They needed something that would prevent the currency chaos, competitive devaluations, and economic nationalism that had helped fuel the Great Depression and contributed to the conditions that made the war possible. What they built was a system in which every major currency was pegged to the United States dollar at a fixed exchange rate, and the dollar itself was fixed to gold at $35 per ounce. Any foreign government holding dollars could walk up to the window, so to speak, and exchange them for gold at that rate. The dollar was, in the truest sense, as good as gold. And for roughly 25 years, it worked extraordinarily well. The global economy recovered and expanded. Trade flourished. The dollar became the anchor of international finance. But by the late 1960s, strain was building. The United States was spending heavily on both the Vietnam War and a sweeping expansion of domestic social programs, what was called the Great Society. Dollars were flowing out of America faster than goods were flowing back in. Foreign central banks were accumulating dollars, and some of them, most notably France, began doing what the rules allowed them to do, exchanging those dollars for American gold. The U.S. gold reserves were depleting. By 1971, it had become clear that the United States did not hold enough gold to cover all the dollars that existed in the world at the official rate of $35 per ounce. On the evening of August 15, 1971, President Richard Nixon went on television and announced that the United States would no longer honor the gold convertibility of the dollar. The gold window was closed. What was described as a temporary measure turned out to be permanent. Within 2 years, the world had transitioned to a system of floating exchange rates. The dollar was no longer backed by gold. It was backed, as the phrase goes, by the full faith and credit of the United States government. That faith and that credit have been the foundation of global finance ever since. This moment, what economists call the Nixon shock, had consequences that continue to ripple through the present day. The most immediate one was that central banks, which had previously needed to hold gold as the anchor of their monetary systems, no longer had a formal reason to do so. Over the following 3 decades, many of them actually sold their gold. They preferred to hold U.S. Treasury bonds, which offered a yield, rather than gold, which didn't. The dollar deepened its role as the world's reserve currency. American Treasury debt became the asset that central banks everywhere kept as their primary reserve. That arrangement worked, with periodic turbulence for roughly 5 decades. But something shifted around 2022, and it shifted in a way that the data suggests is structural rather than temporary. The catalyst, at least the visible one, was geopolitical. When Russia invaded Ukraine in early 2022, the United States and its allies responded with an unprecedented economic measure. They froze more than $300 billion in Russian central bank reserves held in Western financial institutions. The message this sent to every other central bank in the world, particularly those in countries that had complicated or adversarial relationships with Washington, was visceral and immediate. If your reserves are held in dollar-denominated assets within the Western financial system, they are not unconditionally yours. Under the right political circumstances, they can be frozen, blocked, or rendered inaccessible. Gold is different. Physical gold, held in your own vaults or in politically neutral locations, cannot be frozen by another government. It cannot be sanctioned. It has no counterparty risk in the traditional sense. It existed as money long before the dollar did, and it has never gone to zero. For central banks that had been quietly accumulating a concern about their vulnerability to dollar-based sanctions, the freezing of Russian reserves was effectively confirmation of a risk they had long suspected was real. The rush to diversify into gold accelerated almost immediately. What makes this development particularly significant is that the World Gold Council's 2025 survey of central banks, which drew 73 responses, the highest participation since the survey began, found that 73% of respondents expect the share of U.S. dollar holdings within global reserves to decrease moderately or significantly over the next 5 years. At the same time, a majority expect the share of gold to increase. These aren't anonymous retail investors guessing at trends. These are the reserve managers of sovereign central banks, describing their own forward intentions in a confidential survey. The signal is unusually direct, and an interesting behavioral detail from the same survey. The share of central banks actively managing their gold reserves, not just holding it passively, but adjusting positions and strategy, rose from 37% in 2024 to 44% in 2025. Gold is increasingly being treated not as a dormant relic, but as an active component of reserve policy. That shift in posture matters because it suggests the institutional commitment to gold is deepening, not plateauing. But the story isn't only about geopolitics. There's a deeper, slower-moving dynamic that the gold market is beginning to price in, and it has to do with the long-term credibility of the major reserve currencies and the debt loads attached to the governments that issue them. The United States national debt crossed $36 trillion in late 2025. The Congressional Budget Office has consistently projected that debt will continue growing as a percentage of GDP for the foreseeable future, driven by mandatory spending on healthcare and retirement programs and the compounding cost of interest on existing debt. The U.S. is not alone in this. Japan, the United Kingdom, France, and most other major developed economies carry debt levels that would have seemed unthinkable a generation ago. The response to both the 2008 financial crisis and the COVID-19 pandemic involved massive expansions of central bank balance sheets, the technical term for creating new money to purchase assets and support the financial system. Globally, the amount of money in existence grew substantially and quickly. Gold, across centuries and across cultures, has functioned as a store of value precisely because no government can create more of it by decree. The global gold mining industry produces roughly 3,000 to 3,500 tons per year, constrained by geology, extraction costs, and decades-long project timelines. It is, in the most literal sense, a finite and slow-growing asset in a world where paper claims have multiplied rapidly. When central banks buy gold, they are, among other things, expressing a judgment about the long-term value of their own currencies. or more precisely, about the currencies of other countries whose debt they have traditionally held as reserves. The World Gold Council's annual survey of central banks has found that a growing share cite concerns about sanctions and an anticipation of changes in the international monetary system as explicit reasons for holding gold. That is a striking admission. These are not fringe institutions. These are the monetary authorities of sovereign nations, and a significant number of them are now openly stating that they are positioning for some form of change in the order that has governed global finance since 1971. China's central bank has been one of the most methodical buyers. Official holdings have grown from just over 1,000 tons in 2015 to more than 2,000 tons by mid-2025, and most analysts believe the actual figure is somewhat higher than what is formally disclosed. China has simultaneously been reducing its holdings of U.S. Treasury bonds, which stood at roughly $1 trillion in 2013 and had fallen to around $688 billion by October 2024. That is a deliberate, gradual rebalancing from paper claims on the American government toward physical gold. Poland, India, and Turkey have also been among the most aggressive accumulators. Altogether, 23 countries added to their gold reserves in the first half of 2025. This is not a single-country phenomenon. It is a broad, decentralized, simultaneous decision by reserve managers across the globe. In October 2025, something quietly remarkable happened in the long-run accounting of global reserves. For the first time since 1996, the combined gold holdings of foreign central banks exceeded their holdings of U.S. Treasury securities in value terms. This crossover was driven partly by gold's price surge, and partly by the deliberate accumulation we've described. But however you account for it, it represents a meaningful symbolic shift in what the world's monetary institutions consider their primary reserve asset. What does all of this mean for the price of gold going forward? That's a question worth thinking about carefully, because the answer is more nuanced than it might first appear. The financial institutions making bullish forecasts for gold, JPMorgan, Goldman Sachs, Bank of America, UBS, are not doing so out of sentiment or enthusiasm. They are running models that track the relationship between tons of quarterly demand from investors and central banks and the resulting price movement. JPMorgan's research notes that this relationship explains roughly 70% of the quarter-on-quarter change in gold's price. Their projections for 2026 assume continued central bank buying at approximately 755 tons for the year, lower than the record years, but still nearly double the pre-2022 average, combined with rising inflows into gold exchange-traded funds as interest rates decline and investors seek alternatives to bonds and cash. ETF demand fell sharply during the period when interest rates were rising rapidly because high-yield bonds and money market funds competed effectively with a non-yielding asset like gold. As rates fall, that calculus reverses. There's also a supply dimension that rarely gets adequate attention. Gold mining is not a business that can quickly expand output in response to a price signal. It takes 10 to 20 years to bring a major new mine from discovery through permitting, development, and into production. Ore grades at existing mines are declining on average. Environmental permitting is lengthening. The implication is that even with gold prices at levels that make mining extremely profitable, new supply is slow to materialize. That structural tightness on the supply side reinforces the price pressure coming from the demand side. None of this means that gold moves in a straight line. It doesn't, and it won't. History is full of episodes where gold surged dramatically, then consolidated, then corrected, before eventually resuming a broader trend. The asset is not without volatility. Prices can and do fall, sometimes sharply, in response to rising real interest rates, a strengthening dollar, or a sudden improvement in global risk sentiment. Anyone watching this should be aware that the scenario in which gold reaches $5,000 and then revisits $4,000 or lower is not inconceivable. Markets don't grant certainty. But the more important question isn't where gold closes on any given day or year. The more important question is what the sustained, a decade's rare behavior of central banks is telling us about their collective assessment of the monetary system they operate within. Here's the tension at the center of all of this. Central banks are the institutions responsible for managing, stabilizing, and lending credibility to the currencies they issue. They hold press conferences to explain that inflation is under control, that growth is manageable, that the financial system is sound. And simultaneously, with remarkable consistency and increasing urgency over the past 3 years, they have been moving a growing portion of their reserves into gold, the one asset class that has historically served as an alternative to paper money, precisely when confidence in paper money is uncertain. That doesn't mean financial collapse is imminent. It doesn't mean currencies are about to fail. The dollar's structural advantages, its liquidity, the depth of U.S. capital markets, the global infrastructure built around dollar-denominated trade, don't disappear overnight, and possibly never disappear entirely. What it does mean is that the people who understand monetary systems most intimately, who have dedicated their careers to managing them, who have access to information that never appears in public reports, appear to believe that the world's monetary architecture is in a period of gradual but meaningful transition, and they are quietly positioning for that transition, 1 ton at a time. The last time the world went through a fundamental shift in its monetary architecture was 1971. The system that emerged from that shift, floating exchange rates, dollar primacy, the era of the fiat currency, lasted more than 5 decades and shaped every aspect of the global economy we know today. Shifts of that kind do not happen in a month or a quarter. They happen slowly, then faster, then suddenly the new normal is the only normal anyone remembers. Gold at $5,000 is not a prediction about the end of anything. It is a data point. A price set by millions of buyers and sellers, including some of the world's most sophisticated and well-informed institutional investors, telling us something about the relative value of a physical, finite, and indestructible store of wealth in an era of expanding paper claims. Whether that price keeps climbing, stabilizes, or corrects from here, the behavior behind it, the sustained record-breaking accumulation by the world's central banks, is a signal worth understanding. That understanding is what Chart Chamber is here to help you build. If today's analysis gave you a clearer picture of what's driving gold and why it matters, do us a favor and hit the like button. It genuinely helps other people find this kind of content. And if you want to keep following the macro forces that shape markets, currencies, and the global financial system, subscribe to Chart Chamber. We'll keep doing the work of making complex systems legible, without the noise, without the hype, and without the shortcuts. See you in the next one.